So just wanted to thank you again for coming to take some time out of your day to come learn. Today's topic, we're going to be talking about breakouts and trying to properly trade breakouts, because a lot of people that I've seen trade breakouts, but they also kind of get faked out very, very often and not really realizing why they get faked out. So we're going to try to break down a couple different breakout trades. So first off, what is an actual breakout? So a breakout usually is either to the upside or to the downside out of a key level. So for example, let's just say AMD key level is at $100, right? So usually you'll start to see some movement either up or down after that breakout level of that key 100, either to the upside or to the downside. And then usually that's when people like to come in to trade that more for a momentum based trade, because a lot of volume is funneling into that, right? But this is then the problem, because they see stuff like this happen very often. They see, they miss out on a fair bit of the move. They miss out on a huge rally like something like this the other day on QQQ. And this is where they get the euphoria factor. They start feeling, oh, it's a lot of FOMO's coming into me. Lots of emotions are coming into me because everyone's caught all this move up here. And the breakout has happened because here's yesterday's high of day, and then we broke out of it, right? So, and then people try to start chasing all the way up here. They chase in this general region because they didn't catch any of this stuff right here. So what happens is you end up basically getting a really, really bad risk reward management, like super, super poor risk reward management. Because if you think about it, let's just say you finally enter during the consolidation, and what happens is you enter right here at the top, right at 343.35, right? So after QQQ pretty much just ran what, like $5, you're like, okay, I'm finally going to get into this trade because we're starting to kind of halt a little bit. This is already a really bad idea because your risk to reward is not in your favor, because there's could be a very, very strong likelihood that this right here doesn't even happen and you just get completely shorted back down, right? So that's kind of a probability one, scenario one situation. Situation two is, yes, we could very well continue higher. In this case, we did. We continued higher about another 1.5 or so, but you didn't really get a very good entry, because if you think about it, when more people are funneling into a specific option chain, usually what happens is when more and more buyers are funneling in and funneling in and funneling in, that increases your implied volatility. What happens when your implied volatility increases is the cost of your contracts go up, right? So you're paying more money for your contracts, right? So what happens is if you end up entering up here at the top, you're paying pretty much a very high premium comparatively to right here at the bottom for the pullback. Now, this doesn't look like a lot, but this is still a 50-cent pullback. So you're buying an inflated IV, whereas down here, not much, it's very cheap in comparison, right? Because people are potentially either getting stopped out. It really depends. Like there's tons of different scenarios that could happen. These could be just straight profit takers. This could be a buyer getting stop lossed out, right? It could be so many different variables, but pretty much you don't want to be buying the initial impulse like this. Like after a move has just happened like this, you don't really want to be buying as it's still steaming higher, right? You want to be buying during a pullback. Now, it might not click in your brain at first, but this is the correct mentality. You don't want to be buying here. You want to be buying on a pullback, right? Because what happens is when people get faked out, in a sense, like whoever is buying this specific breakout up here, this is probably where their stop loss was right here. This is some people getting liquidity trapped, right? So their stop loss is getting hit, and smart money and bigger money is actually positioning themselves here for another drive higher, right? So here's retail basically getting trapped out because they're trying to buy another breakout thinking it's going to go higher. It does, but it goes higher about 15 to 20 minutes later, right? So you want to pretty much buy on a pullback instead of buying the initial impulse as it's still going higher, because you have to realize just because we steamed higher and higher and higher doesn't mean there's not going to be a pullback, right? We had a very strong uptrend pretty much the first half of the day. We had slight tiny bit of pretty much not very much retracements, but the retracements did happen because we have to have breaths, right? So the breath up, the consolidation with the breath down, the breath up, the consolidation, the breath higher. And then finally, we hit that key level of about 346, right? And then we kind of just, in a sense, fluttered for the rest of the day until the last about 20 minutes. So pretty much my point is, if you miss the initial impulse like this, try not to get the euphoria aspect, because when you get the euphoria aspect, that's pretty much the market makers doing one leg higher up on you, right? They're in a sense hoodwinking you because they want to get you to have that euphoria aspect. They want to trap you. Like, that is their job. They don't care about anything else besides providing liquidity, right? So this is them providing liquidity. People sense euphoria, think we're going to keep going higher. Oh my goodness, this shit's going to keep going higher. I got to get into this trade before I'm FOMOing, right? So then the euphoria candle happens, people get trapped, and here's the stop losses getting hit. People got trapped here, stop losses got hit. Basically people got fearful, they sold out. And then this is where, because you have to remember, every transaction, there's a buyer and a seller. So people who are selling here, their stop losses, people are also buying at a good time positioning, right? They bought at a position where it's suitable for them, and then they actually got rewarded, right? So let's kind of go down on a smaller time frame real quick. Where were we? Over here. Also, another thing, actually 3 minute will probably be better for this one. So another thing is, a lot of people pretty much don't buy with high conviction. They see, actually probably the best would be the 1 minute for this specific example. One sec. So a lot of people get trapped right here, right? Tons of people get trapped right in this setup because they think it's going to keep going higher. It's going to keep going higher. They're not realizing and taking into account whole psychological numbers, right? We're right here at 345. We're hovering over 345. So this is where market makers love to pretty much position themselves, and where big money love to position themselves pretty much to have liquidity traps, right? So as soon as we actually broke higher and hit that 345, what happened? People that were positioned there ended up getting filled, and we ended up, pushing us down another pretty much almost $1, right? So what happens is, people that are buying this breakout are just, in a sense, they see that the breakout's failing. So what happens is they fumble it, and their stop losses hit. So right here, this is these couple candles are people's stop losses being hit, right? So I'm sure you've seen this hundreds and hundreds of times, where you're in a trade and it's not working in your favor, and this is when you get emotional, you start getting fearful, and you're like, oh geez, maybe the stock's just going to keep plummeting, I should probably get out of this trade. And what happens is, the moment you start trying to get out of the trade because you position yourself in a horrible manner, because you started buying the actual breakout, the impulse, whereas even if you did buy the impulse, like, that's okay, some aspects, but people bought right up here, right? They bought up here instead of like down here, right? At least buy in before the impulse, not after the impulses actually happen. Same exact mentality. When the impulse happens, the IV gets inflated, your premiums on contracts increase. So you're basically buying much more than you need to, when you could have just waited simply, right? So same exact thing. Retail is getting trapped at that key 345 number. And then the market maker wants to do their job. They want to provide liquidity. So they pull the price back down where people are actually more interested. This is where people are interested. and then they start picking back up the liquidity. So whoever just had the stop loss and sold out of fear, the other pretty much candidate, the smart buyer, actually bought that position and had another little drive up for about $1.50, right? And also you have to think about it. Your risk to reward if you buy up here is shit. Like plain as day, it's shit. Because if you think about it, so one sec, let me map it out. So let's just say you bought way up here. And we already know that this area, because we already did a support and resistance and liquidity, we already know that this area would be our pretty much our target, right? So here would be our target, let's just say right here. And then we would have to go all the way back down, ideally, because underneath this, because here's a low, here's a high, here's a low, here's a high. Ideally, our stop loss would be pretty much under here, give or take. So let's just pretend none of this happened. So we're only seeing that. So that's our stop loss and that's our thing. So in this case, this is a one-to-one risk reward. If anyone doesn't know, one-to-one risk rewards are literal shit. And you should not be trading this, period, because you're not going to be profitable trading one-to-one ratios, right? And you also have to realize that you got an inflated cost here. You paid more money for this contract. So any specific down draw that comes into effect, you're in a sense getting crushed, because let's just say, just for an easy example, let's just say you bought the contract up here for $100, right? But then this pullback right here, this pullback is not very significant. It's about an 80-cent pullback, but you pretty much just lost 50% of your position right here, right? So buying at a correct time is very, very important. It's very, very, very important, because you have to realize about risk to reward. Risk to reward is the utmost importance with trading. Risk to reward and risk management, pretty much, right? So try to identify yourself when you're, in a sense, feeling this euphoria, right? Because the market makers want you to feel the euphoria right here. They get that huge spike, right? And people try to just say, oh shit, I gotta get in this trade. The market's about to go higher. After a 60-cent move, people start to buy. Like, no, you don't buy after a 60-cent move. You're gonna get shit on, right? If anything, you would want to buy during the consolidation right here. That's it. If you miss this move, then you miss that specific setup. But people, retailers like, oh my God, I gotta get in this trade. And this is what happens. They buy at the top and they get shit on pretty much 50% of the time, right? So don't get that euphoria aspect. Try to eliminate that and identify when you start feeling that aspect, and just be like, oh, no, let me take a step back. Let me take a step back. Let me wait until a pullback, and then I'll get into a trade, as long as the volume is still in my favor, right? Because you have to be identifying about the actual volume, right? So this is a prime example of where market makers want your euphoria, then they trap you, and then they get the liquidity, and then they push higher without you, because here's your stop loss and here's them just pushing right up after you, right? So that's kind of an example is right there as well. So then if you want to do another example, kind of the exact same thing. Literally, they did the exact same thing 15 minutes later, right? We push out, we impulse out, have some buyers trying to break out there, try to break out there. We had 3 failed breakouts right here, right? So then finally, we had another little liquidity grab, right? So liquidity went all the way down here. And we actually, if you look here, this right here of 344.70 was pretty much a support there and right there. So we came right back down to once a resistance and turned it into a support. And whoever tried to buy up here at an incorrect time again, they paid a lot of premium. And then here's their stop loss getting trapped, right? They got trapped out, and then they sit there and they're like, holy crap, I just wasted money. And then a couple minutes later, the move that they wanted to happen actually happens, and it goes up without them. So exact same scenario if you want to do that again. So we already know our level, let's just say it's right here. And then our stop loss would technically be under right about here. because we didn't see any of this shit yet. So our stop loss from what we see would be around right about here. So what is this? This is also not even a 1-to-1 risk reward. If you bought up here, you would have gotten shit on, right? Don't buy the initial impulse, fight that euphoria, and buy during either a consolidation or the pullback, right? Because if you bought down here at a correct time, let's just say you didn't buy this. This would be a very good time, but let's just say you bought right here, right? Let's just say you bought right here. So your stop loss is underneath this candle. So let's just give it a little bit of room to breathe. And we already know where our profit is, right? Right around up here. So look at this. This is a 4-to-1 risk reward, right? So this is not even a 1-to-1. This is shit. And if you wait a couple minutes and not have that euphoria, look what happens. You get a fantastic probability, right? If you're wrong, who the hell gives a shit? You're risking 20 cents, right? Who gives a shit? If you're right, congrats. You got a 4-to-1 risk to reward, trade. That's fantastic. Anything, rule of thumb, anything over 2-to-1 is pretty good. If you find 3-to-1, 4-to-1, obviously the higher the better, but anything lower than 2-to-1 is literal shit, and you should not be trading it. So try to understand that the next time you trade something. Hey, is this trade a 1-to-1? Is this trade a 3-to-1? Like, what is it before you even enter, right? Because that's why you can eliminate some of the different. You can basically filter out your trades. And if you see anything that's like 1-and-1 or like 1.5-to-1, like these are the trades you want to stay away from, because they're not really, great. You're basically just wasting your time with them. These type of trades, buying on pullbacks and seeing a once resistance turn into a support and volume is stepping up, these are the type of trades that you want to be taking, right? Because the risk is very, very small and the reward's pretty good, right? The reward is definitely good and favor, right? So same exact thing up here. The retail gets, if you go back on charts, the amount of times retail is trapped out every single day by a market maker is absolutely absurd, right? So let's just say again, holy shit, I missed this. Okay, I missed this impulse. I didn't get in. Oh my God, I'm FOMOing. And then you finally see, okay, I'm going to get in here. After what? QQQ went up. Let's see here. What did we go up at this time? We went up, what? Like 9 points almost. So yeah. So they send QQQ went up 9 points and people are over here. Oh my God, I think QQQ can go up higher, right? No. Just to answer your question, Justin, that's a great time to answer it. What do you do to gauge the ATR so you know the potential move, right? So this is great because QQQ's potential ATR, if people are not familiar with that, ATR means average true range. Basically, the average a stock can go up or down per day. QQQ likes to settle around $6 or $7 per day. So just understanding that, QQQ is already exhausted. It's already ran, like at this time point, it's around about $8, right? So QQQ is already exhausted. So that means the bias that's going in this case, the bullish bias that's going in is going to be exhausted very shortly. So if you bought up here, you're buying basically the top, like you're literally buying the top out of straight euphoria, right? So let's just say same exact thing. You buy the breakout, you're like, oh my goodness, I'm going to buy this shit. And you end up getting filled at the top, right? You end up getting filled towards right here, right? So what happens is your risk to reward is even worse because you get filled here. And let's just say for whatever reason, you take profit right there. And then your risk is obviously underneath the previous candles. Look at the risk to reward. Look at that. That is garbage. That is literal garbage. It's not even a 0.5-to-1 ratio, right? So what happens is people are just, falling into QQQ calls thinking the market is just going to keep going higher and higher, not realizing that ATR is a specific thing. Now obviously it's not 100% accurate, but it gives a very good, educated guess on what it could possibly be that day. So this is pretty good. Usually it's about $7. We won about $8.50, $9. What day was this? The 19th? Yeah, that could make sense. Okay. It was really bullish on Tuesday. So we ended up being super bullish on Tuesday. And then this is where retail also got trapped. They're thinking the euphoria aspect. They try to buy the breakout basically at the top. And what happens is whoever bought up here, they just got absolutely obliterated. They got obliterated because we pretty much went down almost the rest of the day until the end of the day. So we went from 346 almost to 343.50. So whoever tried to buy up here for calls, for whatever reason they're buying calls when they should be shorting it because the ATR has already happened. We're already exhausted, right? The bullish presence is exhausted. So we shouldn't be looking for calls. We actually should be looking for shorts, right? So if you were looking for shorts up here, you would have gotten fantastically rewarded because if you noticed, we had 1, 2, 3, 4. We had 4 separate rejections in a row, basically almost 5 minutes of rejections at a key area, and then we start going back down, right? So if you entered even like here, even if you didn't enter at the top, even if you entered here, this is still a fantastic entry, right? So kind of keep that in mind. ATR is average true range. It is on, it's an indicator that you can put on Thinkorswim. It's an indicator that you can put on TradingView. Just type in average true range and or ATR. It will come up. I'll send a picture of my Thinkorswim later because you actually can put it inside of your watch list. You basically can toggle it inside of your watch list so you know, hey, you know, XYZ stock, how is it performing today? Has it made its ATR move or has it not? If it hasn't made its move yet today, then we could potentially play it. If it has made its move, then I'm not as interested in it. So kind of keep that in mind. SPY big dump today. Can you look at SPY and help us understand when to buy? Sure. So another reason why SPY actually dumped today, so kind of the exact same thing. People, I guarantee you half the chat that you were looking at this morning were thinking about calls, right? They were thinking about calls, right? After the market just moved up. If you look at the end, the market moved up almost 15 points over the last couple of days, right? We went up 15 points, but people are being greedy and thinking the market continue higher. So what happens is, so this is a supply zone that I drew out almost 2 weeks ago. So this supply zone was still current, right? So we came up in the morning, we had a lot of bullish presence, lots of bullish presence, and people got trapped here. They got trapped because they're like, oh my goodness, SPY's about to break, 350. We're going to go to the moon. And this is where market makers love to get you. This is your euphoria right here. This is human psychology. Then what happens? You get tanked, right? But then we try again. You're like, okay, no worries, no worries. That was just a dip. I'll do it again. What happens? You get tanked again, right? And then we actually made a double top, right? So if anyone's not familiar with what a double top is, that's a bearish pattern, right? So we made a double top inside of a supply zone, which is very, very bullish. I mean, excuse me, that's a very, very bearish census right there, right? So then what happens is we end up rejecting and falling down. And then what happens is same kind of mentality. People are trying to buy the breakout. They're buying the breakout to the downside. And what happens is we ended up kind of respecting, pretty much retracing back to that initial impulse zone. This is where you want to enter, right up here. When we get the respecting of that initial breakout zone, not here, because when we enter here, what happens? Our contracts are more money. Remember, when everyone's funneling in, that's when it's more money. But then when we get that pullback right here or right here, either one, this one or this one, these are the times you want to enter, not on the impulse. When we get the pullback, pretty much justifying that this once, in a sense, resistance, or excuse me, this once in a sense support area is now being a resistance area 2 separate times, right? So you want to enter at this pullback or at this pullback, not during the initial impulse, because you're paying more money than you need to, pretty much, right? So then what happens is, just say you enter here, and you would have gotten rewarded pretty very heavily, right? Even for the first leg down, you were rewarded about a dollar or so in what, 5 minutes, right? So that would be a great scalp or a great, really quick day trade. Had a teeny bit of some consolidation, basically just went range bound for the rest of the last 15 or so minutes, pretty much just range bound. And then this once support over here ends up being resistance, right? Resistance, resistance. Then what happens is we fall back down, all right? So people are trying to buy the breakouts. They're trying to buy here. They're trying to buy puts down here, but they should be buying puts up here, right? So you have to reframe that thinking, right? Because no smart money or no big money wants to get positioned down here for puts. No one wants to do that. They want to get positioned at a correct time and a favorable time for them. They want to get positioned at the rejections, not as is already, pretty much drowning, right? So try to reposition that mentality and not enter on impulses, because you can get faked out and pay more money. Enter on pullbacks, right? Enter on pullbacks. Very, very important, because you save money. Your risk to reward is better. You're going to be less faked out. And even if you're wrong, who cares? You're not risking very much. You're not risking very much at all. Like, if you think about it, if you entered puts down here, this is at 349. This is at 349.40. So your risk to reward is a lot smaller, right? Because your risk would probably be about, let's see here, probably right here. Oops, wrong one. There we go. Your risk would probably be about right up here, give or take, around that 349.50 zone. And then obviously your profit target would be probably low of day at least, right? So that's a 5-to-1 risk reward. Whereas if you entered down here, your stop would be up here, give or take. And then your first target would be right around here. So this is not even a 1-to-1. You see what I'm getting at? These are the things you have to think about, because people do this all the time. They're like, holy shit, let me buy puts at the bottom, or let me buy calls at the top. No, that's garbage. Your risk to reward is shit. Don't do that. Buy on the pullbacks, please. Buy on the pullbacks. Your risk to reward is much, much, much better. All right. Every single example that I've showed you so far today, when people buy it in proper times on basically impulses after the move has already happened, it hasn't been over a 1-to-1, right? Every single time. But then when we buy at the proper time, every single example so far has been over a 3-to-1. Every single one's been over a 3-to-1 race to reward ratio. This one's 5, right? 5-to-1. So kind of think about that, because a lot of people are breakout traders, which is not bad, not bad at all for being a breakout trader. But you have to do it correctly. You can't be buying on the impulses. You have to be buying on the pullbacks, right? Let me just answer a couple questions real quick. Hey Scrub, what's the risk reward tool you're using called? So if you look at your tool section right here on the second one, it would be the wait, was it this one? Hold on, I'm so sorry. Oh, it's this one. It's this one right here. So you long position, short position. I know you have a video that you posted for understanding supply and demand. Can you walk us through that a bit here? So yeah, so 65-minute was right here. So if you look on the time chart, so this is back in April 9th, or excuse me, April 8th. So we had a impulse up, we had a consolidation period. So we basically had a rally, basing, and a drop. All right. So I'm not going to go into the full description of how all the supply and demand works. If you want to check it out, it's right here. I'll link it into the chat if you want to check it out, because it's definitely very informative. I go over multiple types of how the market moves. It moves in basically 4 separate times. It moves in rally base rally, rally base drop, drop base rally, drop base drop. That's basically the 4 scenarios how the market can move. And if you understand that, you can capitalize on it very, very often, right? So what this one does was back in April 8th, we had a rally, basing, drop. So that created a supply zone. So lots of leftover sellers. And when we came into it, look what happened. Sellers got picked up and we went right back down. All right. So that's kind of going over what happened today. How do you handle when you have all your confirmations, but you don't pull the trigger and the stock moves as you thought? Okay. So any advice? Try paper trading. Try paper trading just for a couple of days. It's your executions. If your analysis is good, it's basically you're in fear of something. Are you in fear of losing money? Are you in fear? Like, what are you in fear of? Why are you hesitating? Try to journal about that. Try to understand what's going on specifically for you. And then you could also go on paper trading for a day or two just to try to get back that that edge. Try to get back your confidence to take executions, because if everything's working out in your analysis, then it's not your analysis, it's your executions that you have to work on. But any other questions today that you want to talk about? Anything you want? Any questions? Anything you want to chat about before we go here today? How do you trade a stock? Well, that's a different topic for another day. Well, thank you again, guys, for coming. I appreciate you so much. I do these every single week. Whatever you want to talk about next week, just send me a DM. If you have any questions or something you've been struggling with, try to just message me privately, and I'll create something for you for next week. Also, if you haven't seen, I create weekly newsletters that are in-depth every single week. I release them on Sundays, and they have over a 93% accuracy rate over 7 months. If at all you want to check these out, I'll happily show you them, a copy of them. And thank you so much. I appreciate you. And I'm looking forward to talking to you guys again next week. And then one more trade. When do you supply and demand on stock? Do you turn? No. Keep the extended market hours on. Keep it on, because you have to realize futures happens overnight and there's more volume and liquidity overnight. So you want to keep extended market hours on when drawing supply and demand. Hope that helps. Thank you again, guys. Enjoy the rest of your day. Stay safe.